Employee stock purchase plans, ESPPs, are becoming increasingly popular as a means for Canadian employers to encourage employee engagement and retention. ESPPs provide employees with the opportunity to purchase company shares at a discounted price, thereby becoming part owners of the company. While ESPPs come with significant benefits, it's also vital to understand the tax implications that accompany them. In this article, we explore the tax treatment of ESPPs in Canada, discussing the key aspects employees need to be aware of in order to make informed decisions and maximize the available tax benefits. Before diving into the tax implications of ESPPs, it's important to understand the basic way they function. These plans allow employees to purchase company shares at a discount, usually through payroll deductions. The most common discount is around 15%, but it can vary depending on the company's specific plan. The accumulation period, during which deductions from employee paychecks are made, typically lasts for half or one fiscal year, after which the money is used to purchase shares at the discounted price. The tax consequences of participating in an ESPP depend on whether the plan is considered a qualified or non-qualified plan under Canadian tax regulations. In general, a qualified plan is one that meets specific requirements established by the Canada Revenue Agency, CRA, to be eligible for preferential tax treatment, such as limits on the maximum purchase price discounts, and the shares must be purchased in a Canadian company or its foreign affiliate. For qualified ESPPs, the discounted portion of the share price is not considered taxable employment income at the time of purchase. Instead, this amount remains tax-deferred until the employee decides to sell or dispose of the shares, at which point it would be treated as capital gains. On the other hand, for non-qualified plans, employees must report the discounted portion of the purchase price as taxable employment income in the year of purchase. This amount is subject to regular income tax and can significantly impact the overall tax liability of the employee, especially if the discount on shares is substantial. Regardless of whether an ESPP is qualified or non-qualified, when employees eventually sell the shares they've acquired through the plan, they will be subject to capital gains taxation. Capital gains are calculated as the difference between the sale price of the shares and the adjusted cost base, ACB, which includes the purchase price and any related fees or expenses, such as brokerage fees. If the shares were purchased through a qualified plan, the ACB would include the full purchase price, including the deferred discounted portion. Therefore, when the shares are sold, the capital gain would be 50% taxable. However, if the shares were purchased through a non-qualified plan, the taxable portion of the capital gain would be reduced, as the discounted portion has already been taxed as employment income. Understanding the tax implications of ESPPs can help employees make strategic decisions to maximize their ESPP benefits. Here are a few tax planning tips to consider. When deciding whether to participate in a non-qualified ESPP, keep in mind that the discounted portion of the share price will be taxed as regular income. Make sure you are comfortable with the additional tax liability associated with such plans. Take advantage of an employer's qualified ESPP whenever possible. The tax-deferred benefits can significantly increase the overall return on investment, especially if the share price appreciates in value over time. Plan the timing of your share sales carefully. If you sell the shares in a year when you have other capital losses or lower taxable income, you can reduce the overall tax burden on the capital gains. Consider consulting a financial advisor or tax professional for personalized advice tailored to your individual circumstances. In conclusion, participating in an employee stock purchase plan can be an excellent way to invest in your employer's company and build wealth over time. However, it is important to fully understand the tax implications associated with ESPPs in order to make the most informed decisions and maximize the available tax benefits.